Welcome everyone to this month's executive briefing. This month we have our guest, Ryan Gural. And Ryan, did I say your last name correct, Gural?
It's Goral. That's okay.
Gural. Glad to have you with us from G Spire Group, founder of G Spire Group. And we're just thankful that you're able to join us for this month's topic, maximizing EBITDA. So appreciate that. And you're an expert in this field and want to make sure that you have an opportunity to express yourself from the questions we ask. And Mark Ariel is here with us. He's one of our strategic partners. And we see Frank, thank you for joining us today. And so appreciate you being here. So Ryan, before just giving a little background on Exit Systems, I'd like for you to introduce yourself.
Yeah, sure. About 5 years ago, I started G Spire Group. We essentially help companies grow through acquisitions. We really come in as a executive, fractional executive, if you will, help smaller, lower middle market privately held businesses grow through acquisitions. Everything from strategy formation to pipeline building to negotiating each deal, due diligence, capital integration. So we're a fixture of management teams of our clients, and we drive growth through M&A.
Perfect. Thank you. That's really crisp. And Mark's also here as one of the panelists. Mark, you want to introduce yourself as well?
Sure. I'm Mark Iorio. I've many years of work in consulting, running a marketing firm for over 35 years. And for the last 20 plus years have worked in culture consulting. Charles and I teamed up about a year and a half ago or so to form Exit Systems. Charles is CEO. And I basically come in and look at the culture of an organization, the brand promise that organizations make, and the delivery of that brand promise each and every day. So you saw it last night with Indiana University. We do the same thing basically for companies that want to find a purpose and win each day.
Well, that sounds like a winning transformation. You mentioned Indiana, yeah. So I actually watched that game. That was a pretty interesting, pretty exciting. Just to see a new face. So yeah, appreciate that, Mark, and welcome to all the guests. So I'm, as Mark mentioned, I'm the founder and CEO of Exit Systems, and we help companies grow, scale, and prepare for eventual exit. And despite our name, Exit Systems, we are transformation first. Without transforming your business, it's really impossible to get maximum value out of it when you eventually transition that business through scaling, through some form of transaction, whether that be a sale of your business, some type of acquisition, even succession. So we just make sure you have a valuable, highly efficient company that makes you money today and ultimately makes you more in the future. So with that said, we want to jump in for, again, this month's executive briefing on maximizing EBITDA. And we will begin with asking Ryan some questions and allowing him to respond. So Ryan, you usually help business owners who run their companies, and they make about $1 million in profit, $1 million in EBITDA, and they want to grow their business by buying other businesses. What are the most common operational and financial gaps you see that directly suppress EBITDA early in the M&A growth cycle?
Yeah, sure. So first, before we dive into that, I thought it would be kind of helpful to talk about why EBITDA, why is that such an important lever for valuation? Buyers, private equity firms, investment banks, all focus on EBITDA as the main valuation metric, mostly because it's a good proxy for recurring, controllable operating cash flow. What it does is it strips out certain things that could be different across businesses, such as the capital structure, legal structure. So it gives buyers the ability to compare businesses, kind of an apples to apples comparison across, a number of different industries. So it's a way to benchmark. Um, so, to your first question, you know, a lot of times we spend a lot of time talking about EBITDA enhancement because that's the focus. If we're working with a client that's wanting to buy as part of a prep to sell maneuver, let's say they're doing $1 million of EBITDA, we're focused on not just transacting to drive revenue. That's the wrong metric. We want to make sure that the acquisitions that we're doing are going to be accretive to that EBITDA, both in a dollar, but also from a percent perspective, because buyers are focused on, not only how big the EBITDA is, but what the margin is and how sustainable is it. So when we dig in and, you asked about operational and financial gaps, it's very common with $1 million EBITDA company that there's too much owner dependency on that EBITDA. So we want to look at, kind of reverse engineering. If we make 2-3 acquisitions and get from $1 million of EBITDA to 5, in that process, one of the things that we're focused on is making sure that the business owns the EBITDA, not a single person or 2 key people. Oftentimes it's the owner. So if the owner is overly involved in driving that EBITDA, a buyer is going to look at that as higher risk, which will then lower the multiple that a buyer is willing to pay due to that risk. So owner dependency is one big one that we're constantly helping clients with. The other part is many clients of this size, they don't have a good understanding of the key levers that are driving the EBITDA of the business. So they don't have, for example, monthly financials being closed out in a timely manner. They don't have, any kind of margin segmentation of different services or products. And when a buyer comes in and says, "Hey, tell us about your business, tell us about the margins per service line or product, can you give me the last month's financials?" If a company stumbles with those things or don't have good answers, a buyer could lose confidence in that business and what the reported EBITDA is. So it's really important that a business has that reporting, has the metrics dialed in, know what drives EBITDA, what the margin profile of the business is, etc. Those are common misses.
So I'm hearing something in your response here. It screams that is there a lack of understanding on terms of revenue versus EBITDA?
Yeah, I mean, this is probably a whole other conversation, but revenue is critical to drive EBITDA. Like there's no EBITDA without revenue. But with M&A and acquiring businesses, the focus can sometimes lead to, I'm a $10 million revenue business, this acquisition is going to get me to 20. And that sometimes feels good to an owner. I call it a vanity metric. If the revenue's poor, if it's a customer concentration issue, or the relationships with the customers are fickle, then that EBITDA is just not going to be sustainable. So there is obviously a big difference between revenue and EBITDA, but when we're talking about acquiring a business, we want to be focused on not just the revenue generation, but the quality of the revenue and making sure that it's sustainable from an EBITDA perspective. Does it drop all the way down to the bottom line? Does it do it consistently, etc.?
Okay, yeah. Mark and Michael Neal also joined us as one of our panelists. One of you have any comments or questions?
Ryan, one of the questions I keep thinking about with you is your background and the lead up to G-Spire and how you saw a need in the marketplace for organizations to use G Spire and your banking background. What did you see out there that said to you or spoke to you in terms of, hey, there's a gap and I need to fill that gap? What was that?
Yeah, it's a function of two things. One, it's a function of capacity, and then a function of know-how. So as a lender, and I was focused on M&A transactions. I'd get referred a business that wants to make an acquisition. I would say, great, let's get some money out the door and let's help you transact. But then as I watched them go through the process of, sizing up the deal, structuring the deal, doing due diligence, the business owner is also operating their company. And I just saw them not, have the capacity to do the necessary work that goes into growing through acquisitions. A lot of times they don't have anyone on their team that has additional capacity or specifically any M&A expertise. And then I'd see them go kind of fumble through due diligence, get all the way to the closing table. And then I would ask them, all right, what's the strategy? What happens after you get this done? Are you going to do another one? What's the integration plan? And they would give me a blank look back. And that happened enough where I said, I think I want to serve these business owners in a more intimate way than just, putting debt on their balance sheet. I saw a need for someone to bring capacity, bring the know-how to actually lower the risk of growing through M&A. And that was the origin story of G Spire.
So as a follow-up to that, Ryan, when you saw that like pre-deal flow, but with regard to post-deal flow, when you're doing a deal and you've done the work, what are the pitfalls or what are the things that you see as the leader of G Spire? What are the things that you see with these organizations from an integration standpoint once they've merged?
Yeah, so I'll answer that in two ways. One, integrations tend to be column fail or less optimal when the integration isn't part of the initial investment thesis. Meaning, when you go out and acquire a business, you kind of need to be already thinking about integration. Where are the synergies? Where's the financial leverage? What's the strategic importance of the acquisition? The integration needs to be a part of that initial thought process. And companies that don't think about acquiring a business with the end in mind, and they just want to transact for transacting sake, can lead to problems in integration. And then the second part of that is more practical, which is where areas that businesses fall down in integration. Most of it can be summed up with just a lack of planning, whether it's communication planning, whether it's mitigation planning. So what if, Joe, the GM, quits within the first 2 weeks, which I've seen happen, and now they're like, oh, well, I don't know what's going to happen. Well, part of the planning process needs to be thought through. What if Joe leaves? What if the GM leaves? What would be the next 3 steps that we would make to mitigate the risk of how important Joe was? So I think it's a lack of planning. And then, I guess the third leg of that stool would be once you're in integration, you bought it, it can feel pretty overwhelming pretty quickly. You got things going wrong. You got 2 businesses to operate. You got systems that you're trying to integrate. And I've seen where that overwhelm, because they don't have enough people deployed to properly integrating, lead to just delayed decision making and kicking the can down the road. We'll fix that later. Which just, the more you do that, the bigger the web of problems that tend to come up, versus having a plan and having quick action based on that plan, so you can move forward with a clear line of sight. So those are a few areas of where I've seen integration fall short.
And my last question for you, Ryan, is from a team standpoint, an ecosystem standpoint at G Spire, how when you finally find the right fit and you help the organizations acquire or do an M&A deal, what is the role that G Spire plays, and how do you see that through so that you ensure success going forward?
Yeah, so a couple ways. One, part of our model is we stay involved in the integration process. So we're not just bringing deals to our clients, getting them closed and moving on to another client. We're meant to be in there from strategy through integration. So one of the things that we do is during due diligence, we're quarterbacking, we're making sure the analysis is getting done. We're quarterbacking all the different accountants and lawyers and what have you that are part of the transaction. But we're also building out the first 100-day integration plan. So what happens on day one, what happens on week one, what happens on month one, who's doing what, why are we doing it, and make sure everyone's on the same path, on the same page. And then once we kind of get through that first 100 days, we then kind of step back and it's rinse and repeat. So most of our clients want to do more than one deal to bridge that $1 million EBITDA to $5 million EBITDA gap, or 1 to 3. Usually it's going to take 2 or 3 acquisitions to get there, in addition to that organic growth. So we, full life cycle, once we kind of help with that initial 100-day integration plan, we're back to the starting line. We rejigger the strategic plan. Now that we've bought this, what else do we want to go, what else is strategic in nature to go acquire? If we have to make revisions to the plan, revisions to the targets that we're talking to, we do that, and then we drive it forward again. And once we're done with those acquisitions, we then, as part of the team, can package and start doing the work to get it ready to go to market. It's shoring up. All right, what's a buyer going to be looking for? Which is stuff that we should have already been talking about and planning for. But where are there holes that we need to fill with some strategic projects before we even go to an investment banker? What things can we be doing to help improve the value of the business, make sure that EBITDA is truly sustainable and healthy, and seeing it all the way to till they sell.
Great, thanks, Ryan.
Frank put a really interesting question, Ryan, into the chat. Do you want to bring that up, Charles? Because I think that's kind of more relevant to the thread that Mark has been bringing up in his conversation with Ryan.
Yeah. Ryan, you want to ask it directly? Or you want me to read it?
No, I've got it here. So the question is, on the subject of maximizing EBITDA, how do you guide counsel sellers on the impact of add backs and how to handle prior to engaging with a potential buyer? It's a great question, Frank. So, and I've seen a million sims, that's an exaggeration, but the add backs is part of getting to an adjusted EBITDA. So it's the EBITDA, what the business is generating. And then as a sale process, very common for investment banks to go, all right, what are the non-recurring, the one-time nature, what's in the EBITDA? Usually it's cost in the cost structure that won't live on going forward. And the more add backs that are in there, the messier the due diligence is. So if, for example, you got $1 million, EBITDA company, and the adjustments are another $1 million, red flags, right? You're trying to sell a $2 million EBITDA to a buyer, and you've got double the stated EBITDA as adjustments. It's going to cause some red flags. So what we want to do as part of why this is such a good question is, I'm not saying we don't add backs, but we make sure that the add backs are thoughtful, make sure that they're sellable and thought through. We also have to make sure we understand the buyer. Are we selling to a strategic? Are we selling to a private equity firm? They're going to treat these add backs differently. A private equity firm, for example, might want to keep on the entire management team. Well, you can't add back the entire salaries of all your management team and expect to get paid for it. So, we do a lot of work with who is the likely buyer here, and let's make sure that we're being thoughtful with those add backs as it relates to the potential buyers. And then, in an ideal world, you have limited add backs and they're clean, which means you just need time of seasoning. So if you have, a one-time, just stupid example, maybe there's some bad debt, okay, that happened a couple years ago for a couple $100,000, but that happens every year. Probably can't sell that as an add back because it's a recurring expense, even though technically a write-off of AR is a one-time event. But if it happens every year, a buyer's going to say, well, that's not a one-time. You clearly have bad AR every year, so we're not going to give you credit for that. So as part of educating sellers on the impact of add backs are big because if you're selling at a 6 multiple and you got $500,000 of add backs, that's $3 million, right? So that's real money to the seller. So we just want to make sure that they're thoughtful, that they're explainable, and not just throwing every penny out there, just trying to maximize dollars, just because we think we can. They have to be thoughtful as it relates to the buyer's lens. Did that answer the question, Frank?
Very well. Very well. I might add, so it sounds like it goes back to the point of engaging with advisors like you all in advance to get these things cleaned up before going to market.
Yeah. I mean, the sooner the better. I think every service provider, the earlier they get in, the more they can add value. We're always an advocate of, the earlier the better, so we can get a handle on the financials. A lot of times we are doing a lot of what I call FP&A type of work. So we're staying on top of our clients, how their financials are performing, what things are add backs, so we can have those active conversations on a regular basis. So when the time comes to go to market, we've talked about them ad nauseam. We understand them. We know where and why they happened, so we can, when a buyer will ask, we'll be ready for them.
So Ryan, with whether it's add backs or whatever it may be, how do you help a seller de-risk the entire potential transaction with the buyer?
Yeah, so there's never zero risk, but there's a lot of things a seller can do, and this is as putting on my buyer's lens. We're buying businesses all the time. The clients that are most prepared get a premium valuation, and the process is smooth. And preparation can look differently from client to client and company to company. But some of the table stakes, having a clean data room with all the information already set up, hiring a good investment bank that does a really nice job summarizing the business, outlining the different margin profiles based on products and services, really telling the story of why this business is worth what we're hoping to get for it. But also it's telling the story of what could this business do within a new ownership structure. So, maybe the owner operated nature of the business, with a private equity firm or what have you, maybe there's opportunities to triple the business. So where are those opportunities? Where because of the lack of capacity on the management team or the lack of capital or whatever the lack is, being prepared to tell the story of, where could this go under the right hands, to get a buyer really excited about, acquiring the business. But preparation, data room, having good quality financials, whether that's reviews or audits. You could even go so far as getting a quality of earnings done. A buyer will likely do their own, but a good quality of earnings will say like, hey, got review statements and we have a QV. You can trust these financials. So there's less conversation around like, hey, this doesn't reconcile, or I don't understand this account. If all that's cleaned up, now we're talking about more strategic imperative, strategic opportunities, team, what's going on with the team. You're having more meaningful conversations than spending it's very valuable time. You got 90 to 120 days to transact. You want that time focused on the right things, not, hey, I got to clean up this account in my books because it's not right. And now you're spending maybe a few days or a week to reconcile it. Now you've taken a week out of the process that could be focused on something more impactful. So those are just some of the areas. And the place that I think people don't put enough emphasis on is thinking about, every business is all about the people. And as a seller, really thinking about what their current team and current employee base, what would that look like in the new hands of that PE firm or buyer? What are the opportunities? What are their strengths? And selling the team as a group of people that are going to stay on post transaction. And what are the opportunities? Maybe there's a key employee that, due to the business's financial profile, can't pay them, what they're worth. Maybe they've been underpaid for a long time, and maybe a new buyer can actually give that person an opportunity through some comp, but also roles and responsibilities for them to be able to take the business to the next level. So it's all preparation and planning.
Nice. So as we wrap up, what is something that you would add that we haven't discussed or asked about?
No, there's so much that you can't cover in 30 minutes, but I think it kind of goes off of a comment I made earlier. Oftentimes people are so focused on the size of EBITDA because everyone kind of understands the private equity game and the fact that a $5 million EBITDA company will demand a bigger multiple for that EBITDA than $1 million EBITDA company. And the reason why a $5 million EBITDA company demands a bigger multiple is because of its deemed riskiness is less, right? So there's more room for error, etc. Well, the quality of the EBITDA is just as important as the size. So just because you went from 1 to 5, but maybe it was due to one monster customer, not really that quality of EBITDA. It's bigger, and potentially you can get a little bit of a higher EBITDA multiple. But sophisticated buyers are really going to look at the sustainability of it. They're going to stress test if they lose that big customer, and they're not willing to pay a premium multiple on a kind of an outsized risk. So I think quality of EBITDA is just as important as the size. And I think we covered that a little bit earlier, but I think it's a point worth making again.
No, I think that's an excellent point. And the key term there, quality of the EBITDA, is really important for the seller to understand that not all EBITDA is created equal.
That's true.
Yeah. So any last questions or comments before we close?
Ryan, I think you did a great job. Thank you. You're right. We could probably talk about this for 2.5 hours, but that's why it's called a briefing.
That's right.
Exactly. Yeah. So Ryan, how can people get a hold of you?
Yeah, just pretty accessible. Social media, my website's pretty thorough. My email's on my website, as long as my wrong or right, my cell phone's on there. But Ryan at gspiregroup.com. Happy to talk to anyone who might need a lending hand.
Excellent. And for Exit Systems, you can contact me directly, Charles at exitsystemsai.com, or you can just go to our website, exitsystemsai.com, and interact there. But we thank you for your time, Ryan. Your expertise comes through, and we appreciate that. Thank you for the guests and the panelists. Wish all you guys have a great day, rest of your week, and talk to you soon.
Thanks, Charles. Thanks for having me.
Okay, thank you.
All right.